China's announcement took the world by surprise, as many had expected it to reopen gradually over the next few months.
China's reopening is a game changer. Imagine how much pent-up demand for travel over the last 3 years for these Chinese tourists. So that's one area. And it broadens, is bigger than that, because as China reopens, you're going to get more consumption that's going to occur. And Chinese consumers will shift consumption away from goods to services. And I think being more plugged in and reconnected back into the global economy will mean that industrial production, manufacturing, all these would be affected or improve as a result of China's reintegration back into the rest of the world.
There was some initial concern that with China ramping up its manufacturing and production capabilities, there could be a spike in oil prices, which in turn would impact inflation. But so far, this doesn't seem to have happened.
If you look at how oil prices have reacted in the first 2 trading days of this year, actually oil prices have slipped further. Brent came down to below $80 per handle. And the reason behind that is that people think with this very rapid reopening, essentially you're going to get a wave of COVID infections, basically being very pervasive in the Chinese society. And given that, vaccination rates and also the proportion of COVID-naive population there, those who have not caught COVID will be very, very cautious about even going out, and participating in general social activities. So ironically, it could actually dampen some of the growth prospects for China in the very short term. So if you look at the recent PMI numbers, for instance, for China, actually they're all in the contraction territory. And some of this, I think, is showing or anticipating the impact of some of this COVID surge.
So how should investors ride the reopening theme in their investments? Some analysts say it might be best to adopt a wait-and-see approach.
There's going to be ups and downs, as we've seen with, as China has reopened now, you actually see that the subway ridership has gone down because people are concerned about the rising COVID cases, they're staying home. So it's not going to be a straight line move. The question here is whether or not the tourist numbers actually materialize and the spending numbers actually come true or not. But what we've seen in other jurisdictions is that you have shortages on the services side. The fact that you don't have enough waiters, enough chefs, enough aircrew, enough aircraft, to meet the burgeoning demand for services. And that's something that will probably materialize in 2023 because of Chinese tourists starting to re-emerge. So that's going to definitely put pressure on the services sector in terms of pricing.
And while the world is focused on China's reopening, analysts say investors should also watch to see how the Fed is going to react. Early indications are that it will not cut interest rates this year until inflation numbers come down further.
We want to look at a few milestones before taking on more risk. So first, we want to see when interest rate starts to peak. We believe that it should peak in the early part of this year. And once that happens, we want to add more duration, whether it's through bonds or maybe into growth sectors. The next milestone will be when growth starts to bottom out. That could happen in the second half of 2023. So once growth bottoms out, we might want to take a little bit more equity risk. But meanwhile, I think we are still very much a bit more defensive when it comes to our equity exposure.
Another area that investors should look to is the bond market.
The standout opportunity right here, right now, in my mind, is investment grade credit. We are seeing yields at levels not seen since 2003, 2004, 2005. So we're encouraging clients to explore that space, focus on issuers or funds which offer a diversified exposure, particularly around Asia. And if we anticipate, as I do, that inflation will eventually moderate and bond yields will eventually fall and the Fed eventually will pivot to a neutral stance, then I think investors, particularly in short duration bonds, will be rewarded and I'm looking and anticipating total returns of around 5 to 6% if investors take advantage of these yields now.
The interest rate markets are actually opportunities as well for people to park cash, right? You know, like short-term yields up to something like 4%. You know, that could be a good way to get risk-free kind of returns as well. So I think we look at it from a overall portfolio basis. Don't forget, well, equities is always the interesting one to play for potential capital gains. Don't forget the bond markets as well, and also cash markets to diversify your portfolio.